That's the closing bell on Wall Street. Now it is Market Domination Overtime. Jared Blikre and Josh Schaefer are going to help me get you up to speed on the action from today's session. I'm going to start with major averages right now because we did have the Dow close pretty much at the lows of the session here, down by about 770 points. That's about 1.8%. And that's after Israel, of course, struck Iran overnight, aiming at nuclear targets as well as military targets in that nation. Now, in the past couple of hours, we have seen Iran retaliate, and then Israel still persist with rhetoric that it will then continue to hit Iran. So feels like people did not want to be long going into the weekend, given some of that uncertainty about that back and forth. We saw the S&P 500 also close near the lows of the session, off 1.1%, and the NASDAQ off by 1.3%. Just to point out a couple of other moves that we saw today that I wanted to note. Interesting here that we did see money come out of treasuries. Yields go up even despite what we were seeing here today, which is a little bit surprising. Gold futures, however, gold did catch a bit of a bid, up 1.5%. And of course, the biggest mover today, crude oil, on speculation, concern, uncertainty about what this will have, effect this will have on Iranian oil exports. So TBD, we will continue to watch that. Jared's got a closer look at today's action.
Thank you, Julie. Yeah, we were watching bonds get bought all week and yields were coming down in response to that strong demand that we saw at the U.S. auctions, and not today. But we'll have to see what the new week brings. And it was definitely an event-driven day, and we could see some of that continue next week. But important to remember that sometimes these geopolitical events, you see a huge spike initially, and then you really don't see that much afterwards. Crude oil today was up 14% at the highs. It closed up 8%, and that's still significant, and we got to watch it going forward. But really, this could go either way, and I think we need to keep that in mind. Here is a VIX, which is at 21.56, so that's above 20, and that's a not insignificant move. Here's what happened over the week, over the last 5 days. I'll show you real quickly what happened in the S&P 500 over these 5 days. Sunk into the red overnight, or well, this morning, and we are down about 0.4%. And I'll just take a quick look at the NASDAQ as well, down 0.6%. And let's look at some heat maps. Only energy closed in the green today, and for the week we are looking at a few more sectors in the green. Healthcare, utilities, real estate in there, well, that's basically unchanged, but also tech. Financials taking the biggest dip to the downside, down 2.5%. Industrials, the best performing sector this year, off 1.6%. And let's go to the NASDAQ 100 to see how things shook out here. Mag 7 all down except for Tesla. That's interesting. Tesla up 2%. That green rectangle there. Palantir also up 1.5%. For the most part, we didn't see a lot of dark red. You don't see a lot of dark red here. Just a few names scattered around. So it wasn't terrible, but nevertheless eye-catching, especially in light of the bullishness that we've seen with the S&P 500 climbing within inches of its record high only recently. Here is the Dow, J&J, that's Johnson & Johnson, and Chevron, the two lone green rectangles there. And let's check out the transports as well. Everything here in the red. Uber down 2.02%, that's in the upper left. Delta down almost 4%, United down a little bit more than 4%, and the airlines just having a tough go at this, as you might imagine. Fuel costs up, and travel interest may be waning a little bit. I'm going to leave us on the leaders, and not surprisingly, a small oil ETF claims the top spot. Also, solar energy, defense, and the ARC components. Well, Tesla's the biggest one there. And then to the downside, regional banks and gambling took the biggest tumble. Back to you guys.
Interesting stuff, Jared, and we'll see you in a bit. In the meantime, Josh is here with me to talk about some of the action from today and sort of more thematically what people are watching here.
Yeah, so something I've written about earlier this week in our morning brief newsletter was kind of the narrative shift that I felt like we're starting to see from it's a Trump-driven market. What Trump posts on Truth Social is the story of the stock market to we're talking a lot more about the economy now. And we're talking a lot more about the Fed, interest rates, inflation. I think even just looking at today's action that you and Jared were both highlighting, I think there's a fair argument that there's a an inflation trade going on there, right? You have oil spiking, you have rates rising, perhaps a fear that the Fed wouldn't cut, right, if we got a spike in inflation, and then just generally over the last week, though, kind of counter to the narrative that was building, I felt, which seemed to be maybe the Fed cuts for good reasons. That conversation was coming up a lot more in economist notes this week, that maybe the Fed could cut because inflation's starting to fall and the labor market is okay, but maybe could use a rate cut. And now it feels like, are we moving back away from that conversation off one day of action? I don't really know, but that's where it leaves us a little bit.
And you saying one day of action kind of brings something home to me that is a discussion that we have around here frequently, which is about the smartness or lack thereof of the markets. In other words, you see this conflict heating up in the Middle East. Yes, you see Israel saying it is going to be a more protracted effort than you have seen in the past. And yet, do we really expect oil prices to A, spike more from here, and B, hold meaningfully at those levels, meaningfully enough and for a sustained enough period to really feed through to inflation? Because oil and gas prices have to stay up for quite a while to make that much of a difference. So are people in the market really that concerned about?
No, market says no, right?
No, it's a headline. It's, you know.
The S&P 500 just fell a little over 1% from almost an all-time high.
Yeah.
This isn't like the market sold off in reaction to this, right? Yes, stocks were lower, but they've been higher for 6 weeks now, right? We've just had this relentless rally. And so I think to see markets take a little bit of a breather because, again, a counter-narrative headwind came, it kind of makes sense, right? You've gotten to a point in the market. I think that's kind of maybe the takeaway is, hello, wake up, we're back near record highs, right? So it's not that easy to just go up every day anymore. Versus when you look back over to April or May, stocks had sold off quite a bit, right? So any reason to buy stocks moved them more than it would move them now.
And it's going to be an interesting couple of weeks because we do have the dot plot coming next week. Not that we expect any difference in rates. And also we're heading into a period where volumes fall way off because we're heading into summer. But at the same time, we've got July 9th, which is the next tariff deadline. So could be a tricky little period.
And supposedly when all the economic data is supposed to be starting to get impacted by tariffs, right? Because we haven't fully seen that yet. And that's supposed to be coming in the summer in July and August.
A lot to consider.
We can't take vacation.
No, oh, well,
we're going to have to stay.
You have to keep working. I'm going to take vacation. All right, joining us now, Ahmed Riesgo, a Chief Investment Officer at Insigneo, which is a financial services firm with more than $27 billion in assets under management. Ahmed, all right, let's start with what we are watching happening in Israel and Iran. So from where you sit, what are the investment implications in the short and long term as we've been trying to sort of puzzle all that out?
Right. So in the short term, I think we really have to see what the scale of escalation dominance is or not. Right. What can Iran do and what can't they do? Obviously, the sort of nightmare scenario from the world economy would be some kind of a blockade in the Strait of Hormuz or disruption of the flow of traffic there. But remember, that hurts Iran just as much as it hurts some of the other players. And then that would also draw in, for sure, a response from the Gulf states and also the United States. So Iran doesn't have a lot of really good options, and that's why I think you're seeing some pretty benign price action. Sure, geopolitical risks are up, so if you have oil as a hedge, that's a good spot to have. I wouldn't get rid of it just quite yet, but what I think you're starting to see is that Iran really does not have a lot of good options.
And so does that imply then, if you're watching oil prices, that we shouldn't be too concerned about a sustained rise in, say, gasoline prices and then that effect back here at home on things like consumer spending?
Look, apart from this geopolitical risk spike, oil is in a pretty established downward trend. It's in a pretty established bear market. So as long as we don't have a closure in the Strait of Hormuz, I would expect oil to resume its downtrend once this is over.
And on the flip side, will the S&P 500 resume its uptrend? As you just heard us talking about, there are a number of events coming up that could be tricky for investors. You have the dot plot coming. You have the next tariff deadline coming. Are those upside risks or downside risks, or we don't know how it's going to go?
Look, we think, based upon our projections, the meat of the S&P 500's gains for the years have sort of already been had. So it's not that we're expecting a resumption of the downtrend or even a revisit of the April lows. But we do think that there's very limited upside from here. Our expected target for the S&P, given where we see the current macro environment, is somewhere between 6,100 and 6,300. So not a whole lot of upside. So this is not a place where we are very compelled, let's say, to jump in and add on risk. At the same time, we don't want to be removing risk either. So we're just sort of sitting tight with our current holdings.
So how do you then maximize your returns this year if things might go a bit sideways from here?
Look, we're looking at adding places or sort of adding risk in sectors and sub-assets that make sense to us. We like the U.S. 10-year at 442, which is the current level that it's trading at. It's actually above the equity risk premium in the markets right now. So if you're basically getting paid the same for owning the S&P 500 and owning the U.S. 10-year bond, we think it makes a lot of sense to add on duration right now. We like also sectors that are paying you income and is not impacted by tariffs, like MLPs. That's one. So there are definitely opportunities out there to which to add risk to your portfolios if you have some extra cash.
I'm curious then if you're talking about, sort of dividend plays to some extent or income plays to some extent, how you feel about what had been a very hot trade, which has cooled off to some extent. And I'm talking about the utilities, which had also been sort of an AI play, right? So is that an area that you would be looking?
Yeah, long term, we still think that's a pretty attractive sector. We think utilities, not only are they going to be sort of, having their sort of traditional roles within portfolios, but we think it's actually a growth sector precisely because of what you mentioned with the AI play. So we like utilities. In fact, we will look for this pause as an opportunity to add risk there as well.
Ahmed, thank you so much. Have a great weekend.
You too.
Tesla U.S. registrations sliding 16% in April. That's according to data from S&P Global Mobility. Joining us now from the NASDAQ, Yahoo Finance senior autos reporter Pras Subramanian. So Pras, what is this data telling us about sort of, I guess, things that Tesla don't seem to be getting much better?
Yeah, it's the first indication now we're seeing now U.S. data, right? So registration data from S&P Global Mobility showed that 16% drop in April year over year. This is happening while other competitors like Chevy and BMW see sales gains. So with regard to Tesla, every model except the Model 3 saw sales drop in the U.S. in April. And this is sort of coming along the backdrop of what we saw in Europe, right? We saw a lot of bad data there, sales data in Europe, most recently for April and May there. So we're seeing an echo here in the U.S. But I wanted to quickly touch on the fact that, we mentioned Chevy at number 2, the very popular Equinox and Blazer EV doing well. BMW also there having some good models. They're seeing some sales gains. And Tesla overnight, last night, maybe looking to address that, the top end of the market, updated the Model S and Model X vehicles there. So new updates there potentially to stem the losses on the top end. But nonetheless, it's still a pattern that we're seeing that has been recurring throughout the Western world and also now in the U.S. now with April data.
And Pras, of course, if investors in Tesla have been watching other things, namely what seems to be sort of, warming, if not warming relations, at least not further cooling relations between the president and Elon Musk. And also, they're looking ahead to the robotaxi launch, which has been pushed back, yes, to June 22nd. So we'll see if it gets pushed back more. But there does seem to be some optimism building around some of this stuff.
Yeah, you saw Musk backtrack a little bit on those comments he made last week about the big beautiful bill, talking about how it didn't really cut a lot of the spending, but mostly with a subtext of him being upset about potential loss of the EV tax credit. That being said, the robotaxi launch or test in Austin is happening. We've seen some cars going back and forth to chase vehicles, but the actual official start, Musk says, won't happen until the 22nd. That was a pushback from the 12th that was previously reported. And Musk also said the 22nd date could be pushed back just because of safety and precaution, looking to be sort of cover all their bases with such a big, high-profile test happening in that city. But we've talked about this before. This is a big news for Tesla, a big move. They need to do that to unlock value. But Waymo's been operating in Austin and also other cities for some time now. So they got a lot of catching up to do when it comes to that robotaxi business.
Yes, we'll see how it plays out. Pras, thank you. Stick around, more market domination overtime still to come. We'll be right back. The U.S. Army is marking its 250th anniversary Saturday with a day-long festival and parade that happens to be coinciding with President Donald Trump's 79th birthday. Yahoo Finance's Jennifer Schonberger back with us for what to expect in D.C. this weekend. What is this going to look like, Jen?
Yeah, that's right, Julie. The U.S. Army will mark its 250th birthday, complete with a military parade, one that we haven't seen in decades, which, as you said, coincides with not only the president's 79th birthday, but also Flag Day. The parade, expected to be a spectacle complete with vintage military vehicles, weapons, and flyovers, will tell the story of the Army, starting with the Revolutionary War and conclude with the future of the Army. The procession kicks off at 6:30 p.m. down Constitution Avenue, featuring 150 vehicles, from tanks used during the Gulf War to a Black Hawk helicopter and 6,700 soldiers in uniforms. Republican and Democratic lawmakers have fretted over the cost, which the Pentagon reportedly has said could reach $45 million. Now, the parade will conclude with President Trump's remarks and a Golden Knights parachute display. But while this parade rolls through the streets of Washington, 1,900 protests across all 50 states are expected in what's being called the No Kings movement. Protesters are seeking to reject what they call authoritarianism and billionaire-first politics. Right-wing supporters of President Trump are expected to protest those protests, so we could see some clashing across the country on that tomorrow. And if you were wondering why the U.S. Army is marking its birthday right now as opposed to next year when the U.S. turns 250, well, it turns out that the U.S. Army was actually founded on June 14th, 1755, so just over a year before the Declaration of Independence was signed. A little bit of history there for you.
Yeah, right. Interesting fact, trivia, historical trivia. Love it. And then the day after the parade, on Sunday, the president will be heading to Canada for a Group of 7 meeting. Obviously, we know that past relations with Canada in particular had been tense. What should we be looking for there?
Yeah, that's right, Julie. On Monday, the president's set to meet with his colleagues in the G7, where they're expected to talk about top security and economic issues. According to a senior White House official, discussions are expected to include those on trade, the global economy, critical minerals, migrant and drug smuggling, wildfires, international security, artificial intelligence, and energy security. The president said to be eager to discuss trade relationships and making those fair and reciprocal, while also opening up new export markets for the U.S. He also wants to try to make or position the U.S. to be a leader in artificial intelligence.
Jen, thanks so much. Appreciate it. Well, those protests against immigration raids have been spreading in the U.S., and as we just heard, they're expected to further galvanize more protests this weekend. Several industries are also facing the weight of President Trump's immigration crackdown. Undocumented immigrants make up an estimated 15 to 20% or more of the U.S. workforce in industries like crop production, food processing, and construction, according to Goldman Sachs. To discuss specifically the impact on housing construction, we're joined by Kinloch Partners co-founder and CEO Bruce McNeilage. Bruce, it's good to see you back on the show. And this is an issue that we've spoken a little bit about before. I'm curious, first of all, as we see sort of an expansion of this crackdown, what you're seeing in your business, what you're hearing about from your colleagues.
Sure. So at first, in the first few weeks, we did see a little lull in construction. We haven't seen anything major lately, and I think it was just a little lull. I don't see any major problems on construction sites building homes. And we have such a deficit of homes and so many homes that need to be built in the United States. We just don't see ice. We don't see any interruptions. And I've talked to different folks on job sites, and they said they haven't seen anyone. There haven't been any issues. And so I think that's good if you're in the home building business.
Now, remind us, Bruce, Kinloch Partners, you guys do build to rent primarily, and you're mostly centered in the Southeast. Is that correct? Is that, I wonder, do you think that sort of the lack of disruption is regional, or do you think that the housing industry is being spared to some extent?
Yes, we're in Georgia, Tennessee, and South Carolina, throughout those states. And regionally, the answer to your question is yes. There is a heavier percentage of Hispanic construction workers in Texas and California than there are in the Southeast. Now, there's still over 60% of your roofers are Hispanic, over 50% of your painters are Hispanic nationally. And I've never seen a roofing contractor, quite frankly, that is not Hispanic. I've never seen a painter and a painting crew that is not Hispanic. And so it's prevalent throughout the country. But in the Southeast, we see a little bit less. And in Texas and California, it's a higher percentage.
And Bruce, I'm just curious here, right? If you're, if you've got a roofing company or if you've got some kind of construction company or a contractor, I mean, even when I've been hired for various jobs, I'm not giving them my birth certificate. You present a driver's license in many cases, which many immigrants can get, even if they are not in this country legally. So what I guess is the responsibility of the employer in terms of trying to ensure that these folks are in the country legally?
That's an excellent question. And all these folks that get hired to build houses are subcontractors. The companies are asked to produce licenses, workman's compensation insurance certificates, and things like that. But then downline, the different workers of those subcontractors are usually not checked. So it's really the responsibility of the subcontractor, the roofing or the drywall, the companies that are doing the building to manage that. And it's not the responsibility of the home builder.
Bruce, how much is labor a constraint right now? I mean, we were having a discussion about housing more broadly earlier in the show, and it seems like demand is more of an issue because of higher rates right now. So in other words, is labor even an issue right now in trying to get new housing built?
Yeah, so for a while we were constrained by supply chain, right? And that seems to have solved itself. Labor is at a significant low, and it's very tough to find certain workers, especially the skilled trades. And so we don't see that changing. And we have to pay more and more for labor and more for workers, in addition to more for materials. And it costs more to build a house. The land costs more, the labor costs more, and the materials cost more. And all these things are adding to the cost of housing and making housing less affordable.
And so that brings me also to the issue of tariffs, right? You mentioned materials are going higher. Have you seen that sort of direct impact from the tariffs on some of your materials?
Yeah, a significant amount of your lumber comes from the Pacific Northwest, from Canada. And so we're taxing, or we have tariffs on that lumber, and it's tougher to get, and it's also costing more to buy that lumber. And so tariffs can have a negative effect. You may be looking at China or some of these other countries where you're putting tariffs on those countries, but you just are really hurting the United States and home building too when you put tariffs on lumber that's coming out of the Northwest, out of Canada.
And Bruce, how much of all of this are you able to recoup through raising the rents on your properties?
That's an excellent question. We've only been pushing rents about 2 to 3%, which we feel is very reasonable. We are eating a little bit of that as far as home building and what we're charging for rent, but we're trying to keep rent reasonable because people are just so strapped and looking for housing, whether they're trying to buy housing or rent housing. And for the first time in America's history, in all 50 MSAs in the country, it's now cheaper to rent a home than to buy a home, given these high interest rates environments that we're in. So we, quite frankly, can't keep up with it. We're 100% full, less maybe 1 or 2 houses in each city, and we don't see that slowing down at any time in the future.
Wow. Well, hope to catch up with you again soon, Bruce. Always appreciate your perspective. Thank you. Time now for what to watch next week. Starting on the earnings front, we got more earnings coming in next week from Lennar, La-Z-Boy, and Smith & Wesson. Lennar announcing results for the second quarter on Monday. Analysts are expecting home sales to go up, selling roughly 23,000 homes last quarter. That's around 8% more year over year. Taking a look at the consumer, we'll be getting monthly U.S. retail sales data for May on Tuesday. Economists forecast total sales will fall 0.7%, signaling that consumers are buying less amid elevated interest rates and that tariff uncertainty. Moving over to housing, we'll get some fresh data coming in next week, including housing starts and building permits on Wednesday. Housing starts expected to hold steady at 1.3 million at an annual pace, while building permits tick up to 1.43 million. And finally, of course, the Federal Reserve will kick off its June FOMC meeting on Tuesday. The interest rate decision will come on Wednesday. Fed Chair Jay Powell giving a press conference after the decision, and Yahoo Finance will be starting coverage on Wednesday at 2 p.m. Eastern. We'll also get a new dot plot. That'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell, but don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.